Alternative investments, alts. Do you ever get the sense of FOMO, like everyone else has the secret decoder ring, but you didn't collect enough box tops? Well, today we're going to do three things. First, we're going to dispel myths. Second, we're going to clarify what risk is actually worth taking. And third, we're going to hand you the decoder ring. I'm Greg Lucan with Lucan Wealth Management, and I'm often asked about alternative investments, usually right after someone's been to a free steak dinner with a slick presentation. So let's talk about what's really going on. Do you ever notice how financial professionals sometimes speak in arcane language? Almost like the goal is to sound smart instead of to be clear. Well, I've learned the fastest way through that is to keep asking questions and be willing to look stupid. Because here's the truth. People count on you not asking questions. So let's demystify this. Alternative investments are simply anything outside of public markets: stocks, bonds, mutual funds, ETFs. That includes private equity, private credit, real estate, syndications, hedge funds, managed futures, and some other things. Sounds complicated, but it's not. Here's how I want you to think about all investing. There are only two types of investments, only two. There's ownership and there's loanership. I may have made that second word up, but you get it. You either own something or you loan money and have a claim on something. Everything else is packaging and marketing. Let's break it down. Public ownership. If you own an S&P 500 index fund, you own pieces of Apple, Microsoft, Amazon, Johnson & Johnson, some of the best run companies in the world. Private ownership, or private equity, is simply ownership of private companies. They haven't gone public. Some pay dividends, some get acquired, some fail. That's it. Private loanership is like private credit. It means you're lending to private companies. You are the bank. That was the hot alt investment until about 2025, when some of those funds started blowing up. And once you strip away the jargon, this isn't complicated. So for years, the pitch has been private equity offers substantially higher returns than public markets. But does it? If you search for private equity returns over the last 5, 10, 15 years, you'll notice something interesting. Most of the data is behind paywalls. They don't want to show you the averages. So why? Well, here's my take. David Swenson at Yale used alternatives to improve consistency, not chase moonshots. Managed futures performed well in 2008 during the financial crisis. And then around 2009 and 10, massive amounts of money started chasing managed futures and private equity. Ever heard the phrase closing the barn door after the horses get out? Yeah. Well, you end up with too much capital chasing too few deals during a period of time. That drove prices up. Since 2009, private equity returns have been substantially below public markets. In plain English, your boring ETF portfolio has probably done better. Yes, I know someone invested in Uber early. Exceptions prove the rule. So now let's talk about what really matters: structure. Most alternative investments are partnerships. And here's the catch. Your money can be locked up. No liquidity. Think Hotel California. You can check out anytime you like, but your money can never leave. Often, there's no liquidity at all for the first 12 months. And some real estate funds require waiting until the properties sell. And if the cycle turns, what was supposed to be a 3-year hold can become a 7, 12, or 15-year hold. You don't know when you'll get your money back. So some funds advertise liquidity features. Here's what that usually means. They can redeem up to, say, 5% per quarter. But if 25% of investors want to get out and only 5% get redeemed, well, you're in line. And the general partner can simply decide not to redeem any one at all that quarter. The moment you want liquidity is probably the exact moment the fund doesn't have it. Contrast that with public markets. If you want to shift from real estate to healthcare, seconds. Press a button. With alts, no flexibility, no control, no timeline. So the real questions become, what are the risks? What is the liquidity? And what's the opportunity cost? Now, I have friends who have made phenomenal returns on private equity. I have more friends who have made very average returns. And I've seen some people relieved and thankful just to get their capital back with no return after years of waiting. Alts aren't automatically bad. And here's when they might make sense. Number one, if it's true long-term capital, money you won't need any access to for more than 10 years. If you have entrepreneur access, you understand the business, the timeline, you're really close to the business. If it's truly excess capital, losing it wouldn't impact your lifestyle or retirement. And if those factors aren't true, be cautious. I also have serious concerns about proposals to push alts into retirement plans. The quality of offerings tends to drop when distribution widens, which leads to the most important question. Why is this deal being shown to you? If a fund manager needs $100 million, would they rather go to 5 investors who can each write a check for $20 million each? Or would they rather go to thousands of investors writing much smaller checks? Who gets access to the best deals? It may not be you. It's not me. And there's a powerful pull from the forbidden fruit. That FOMO feeling is real, but don't let it cost you your financial security. Here's what I want you to remember. Ask yourself, why am I seeing this deal? Did I seek this out or am I being sold to? Can I afford to lose 100% of this capital and still be okay? Am I close to it? Do I have knowledge that gives me an edge? If you can't answer those questions confidently, it's okay and smart to say no. You don't need alternative investments to build wealth. The best companies in the world are available in public markets with transparency, with daily liquidity, and far lower fees. If you're being pitched an alternative investment and want a second opinion, we've created some resources on our website. Go to www.lucan.pro and download those resources there.